We are going to be doing a little bit of a presentation on some financial planning ideas here. To set this up, I brought in a guest, Marcel. I met her through a business group called Vistage. Within this network, we get access to very successful business owners, Marcel in there. And a lot of it is, as you guys look for deals and CPAs, a lot of it is per referral basis. I'm personally on the search of looking for a certified financial planner because I've got a lot of alternatives. And maybe not now, but someday I'll switch back to more traditional investments. At one time, I thought that certified financial planners weren't really that useful. And nowadays, once you hit a certain net worth, certainly once you start to face your mortality that you're not going to be here forever, certainly makes a lot of sense. But I think the second point there is finding somebody who is not just working as a minion in one of the big 4 or 5 financial firms. And we won't say the names. Everybody knows who these firms are, but somebody who is a little bit more boutique practitioner, almost emulating a family office for you. I think we've talked about this term called the barbell portfolio. And for those of you guys who haven't heard this concept, if you think of a spectrum of less riskier things on the left and more riskier things on the right, obviously correlating somewhat per the Sharpe ratio theorem, that more risk correlates to more returns. Something on the left side, the less risky, lower return side would be like life insurance, for example, or bonds. Something more riskier on the right side would be venture capital or private equity. Things that would be in the middle would be traditional investments, and it runs the gamut, right, in terms of traditional investments. Apartment investing can mean very different things on the spectrum too. Right now, I prescribe to this idea of the barbell, where if you think of a barbell, it's weighted on the two ends. It's balanced in the center, but you've got a lot of risky stuff, potentially high return stuff, and a lot of low risk stuff, low return stuff. Now, I think most traditionally, especially if you listen to the target date index funds out there or the old 60-40 portfolio stocks to mutual funds, obviously there's no alternative investments in a portfolio like that. It's the opposite of this barbell idea. But that's just an idea of these different concepts up here. And why we do this is get different. When I was talking to Marcel, oh, this is a different take like the barbell, but just a little bit take on this. We're going to get down into some of the numbers here.
I really take from the retirement income industry body of knowledge. My certification is as a retirement management advisor, and I have a team of certified financial planners also at my firm. And one of the reasons why I pursued the RMA is because traditionally, the investment world, at least the investment advisory world, has thought of investing during the accumulation stage the same way during the decumulation stage. So I guess I'll just start by saying, if you look at the statistics, more accidents happen on the way down Mount Everest than they happen on the way up. And accumulating wealth is not always easy, but it is possible. At least historically speaking, in our country, it is possible to accumulate wealth.
It is forgiving because in the accumulation or growth phase, you're making more money, making income, where once you make it and you start to come down, then you don't have that income, that firepower behind you.
That's exactly right, Lane. And so the important thing is once you've made wealth, you want to keep it, you want to protect it. But let's talk about the whole entire picture. So what on your screens is a sample coming from a real client, a real family, household balance sheet. And the reason we start with this piece of information is because the first step you want to take when you're going to decide on different strategies to accumulate, protect, and distribute your wealth is you want to know how well funded your lifestyle is. That's where you want to start, right? So we start with what we call a financial health analysis. And this is not your traditional balance sheet. You could call it a retirement or financial independence balance sheet. Want to be productive and enjoy different types of activities. But at least most of us want to know that at some point, if we so choose, we can stop working or we can work without the pressures of having to make a certain amount of money. So if you look at this balance sheet, and hopefully you can see my cursor, this high number on the right side that says 16 points and change, obviously this is the liability side. And the first question that might come to mind for someone who's not familiar with this approach is who owes $16 million dollars and who do they owe that much money to? The answer is that this family owes themselves the present value of all their future spending. So when we did this plan, she was in her late 40s in 2023, and he's in his early 50s. We are planning out till age 95 and having identified their spending plan or their spending needs, which is based on their essential expenses, their non-essential expenses, their education goals for their children, the taxes that we know that they're going to need to pay, their level of income, etc. Everything is in here, projected out till their age 95 and then discounted to present value. How well funded is their current and future spending? And if it's not well funded, then what can they do? So this is even before we start talking about any type of investment strategies.
People, if
Yeah.
you remember back from like high school or college, that really annoying math formulas they gave you with net present value. And then if you had like somebody giving you $100 a month, what is the future value? What is the present value? That's essentially the math calculation that's been doing right here as a tool.
That's exactly correct. So if we know with a high degree of certainty, just like when we go to the doctors, our health is one thing in our annual physical. One year we may go and we may weigh more, or we may have high cholesterol. The next year we lost some weight, our cholesterol is down. The same thing is true in finances, right? As you review and build a balance sheet of this kind every year, it will look different. Hopefully you saved more, maybe your investment results have been positive, or maybe you changed jobs. So things will look different. And again, we have some maybe non-traditional sources of capital here in the sense that you usually do not see this on a balance sheet. But we also have some traditional assets that are not on this balance sheet. Let me start with financial capital, which is the most straightforward. This is the fair market value, which is the equivalent of present value of this family's savings and investments. What they have in any savings accounts, most of it is invested in the stock market in a diversified portfolio. Some of it is in bonds and some of it is in stocks. But right now, I just want to see what's the fair market value of their assets today, of their financial capital today. But they also have human capital and social capital. And depending on where you are in your life, your human capital may be higher or lower. Human capital is the present value of your future earnings. So you could think of it as money that's owed to you from your employer or from the business you have. So in the case of this family, most of their wealth was honestly created from a startup that then went public, and then another publicly traded company bought that company. The key has been protecting the money they made and continuing to grow the money they made beyond inflation. But again, in human capital, you can see it as a note receivable of money based on their current goals of when they want to stop working that we expect they're going to get. So now we know that to fund these $16.1 million of current and future spending, they have this 13.3 and 2.2, let's say, rounding up a little bit. And social capital is the present value of their future Social Security payments. If they file at age 67 and live till age 95, it's again money we expect they're going to get. Maybe next year, actually, this was 2023. We ran this plan again in 2024. Some of the numbers will certainly look different. But that's why it's important to at least once a year do this to assess where your financial health is. So, as you can tell, the value of any real estate is not in this balance sheet. I did not mention any property. They own a very valuable property and they do plan now after this meeting. They saw that it would make sense for them to downsize in the future. But they also have other plans, and I'll address those in a minute. But for the time being, with the information we had at that moment, we saw that they had about 16.2 million to fund 16.1 million, leaving them a cushion of $45,000. So why did we even bother going through this exercise? Because even though it's summarized on this table, it does take a lot of work because we have to go through their spending, their tax returns, their P&L from his business, et cetera, to get to this number. Obviously, it took a lot of time for them to articulate their goals. We encourage them to have discussions about their values so they can prioritize their goals. We went through this exercise because we want to know, first of all, what is their risk capacity? If this was all they had, which is not insignificant, to fund this amount of lifetime spending, which also is not insignificant, they don't have very much room for error, as you can see, because this cushion is a cushion for them that needs to last for the next 45 years,
I
right?
think
So,
if we can go a little bit more granular, just real quickly over what
sure.
makes up that 16, because I think people are like, I thought if I had $5 million, I'd be there, but this guy has triple that and he's screwed, right?
Yes, it's not how much you have only that matters, it's how much you spend. So, what this story is telling us is that they have a certain lifestyle. That includes paying for private schools for their children and then private college education for their children. It includes certain amount of travel, certain types of vacation. But I mentioned that they have a property that they like to call it their estate. It's a property that's worthy of that name. Maintaining that property is extremely costly. Their level of income at this point is not as significant as it used to be, but it's still significant enough that their income taxes in this number. And then we do expect that they are going to receive income from this financial capital in the future and have to pay taxes on that. They are also very charitably inclined. So they have made some charitable commitments that are into this number. But as we think about our own lives and we think about our essential and non essential expenses, one good question or rule of thumb to ask ourselves is, are we following a 50-30-20 model? Basically, it takes 100% of your income and it says, okay, 50% allocated to essential expenses, 30% to non essentials, and 20% to savings. Now, you can manipulate that any way you want, and you could add a third bucket, which would be gifting. But this type of analysis lends itself to those types of conversations.
Why we wanted to talk about this topic, because I think it expands people's the way they look at their finances, and similar to that needs, wants, and nice to haves, or
Yes,
there's another way of doing that. But what is your annual burn or monthly burn rate then that
I
makes
would
this
say
up?
it's approximately somewhere between $30,000 to $40,000.
And these people, a
At
lot of
this
this,
time, in retirement, private school tuitions go away, college education tuitions go away, but I think it's fair to say that they are spending about 400 to $500,000 a year.
and the older that they are, the lower this liabilities comes down to. Because to me, $500,000 spend isn't not astronomical. So they must be relatively younger then, or
Late 40s, early
sure.
50s. We want the plan to last till age 95. People are living longer, especially people of a certain socioeconomic level, of a certain level of education in terms of healthcare and certain healthy habits, if you will. But when I say 400 to $500,000, that's excluding taxes. That's excluding life insurance premiums. I forgot to mention that life insurance premiums are also in here. And they have some hefty life insurance premiums because they're using life insurance as a wealth transfer tool. And that's a conversation for another day, but they are gifting to trusts that pay for life insurance that will benefit their children when they pass, instead of putting the money directly in their children's hands at an age when the children are not ready or prepared to manage that money. Using life insurance for gifting is a form of leverage. It's a form of leveraging your wealth, right? But back to this, yes, it's a big number, but it's still 16 million, 13 million, depending who you are. Ask somebody who has 50 million and they think 13 million is nothing. But ask somebody who has 1 million and they'd be like, oh, I'd love to have 13 million. So it's all a matter of perspective. If I just go here very quickly, this is another family, very different story. 2.5 million, where their spending for their lifetime is 7.4 million. So I just thought I'd show that to compare, right? Not everybody has the same financial chart.
Yeah, we're gonna be doing another case example, of something that's a little bit more lower numbers after this, but we thought we'd start with this case example of a more extreme case, just academically breaking this idea down. One quick question before you move on that's unrelated. Long-term healthcare, that was something that we discussed in our group as a big unknown and perhaps something to ensure in case you get old, right? And then you
Yeah,
have to go to the care home.
absolutely.
What does that normally cost? And is that kind of a no-brainer you implement there as a bookend?
If you want to see exactly how much long-term healthcare costs in your particular zip code, I encourage you to go to Genworth. Just Google Genworth Long-Term Care Survey. They do an annual survey of long-term care costs per zip code. They also do an average in the United States, but I like to do it based on where my clients are, whether it's on the West Coast or the East Coast, because most of the clients want to stay local. I'm not a big fan personally of traditional long-term care insurance. It has become very expensive, and it is a if you don't use it, you lose it type of proposition. It's also very difficult to get traditional long-term care insurance. I'm more of a fan of attaching a long-term care rider to a life insurance policy or to what are maybe I'm not sure if you've heard of these types of annuities, but they're commission-free annuities. Because annuities have a role in some financial plans for some people. But again, I am very sensitive to the commissions the traditional annuities charge, where there are some commission-free annuities, and that you would get from a fee-only planner. For example, if you have $2 million instead of $13 million, or if you have $13 million in this kind of lifestyle, and then you become disabled, it can eat into your investment money, your financial freedom money fairly quickly, especially if your long-term care event lasts for more than 3 years. So the last statistic I read was that in the United States, on average, people need 3 years of long-term care around age 83. But there are the cases that we've all heard of, somebody who has Alzheimer's at an earlier age and they live for a very long time. Ultimately, it's about protection. So when you do these hybrid policies, so I said add a long-term care rider to a life insurance policy, at least you're not giving up the money. You know your beneficiaries will get the money if you don't use it. There's also something called a hybrid long-term care policy, which is on a life insurance chassis. And you can look up MoneyGuard, for example, comes to mind from Lincoln Financial. They have these hybrid policies. And it's basically like moving money from one pocket to another. You could move $100,000 from the bank to into this policy and leverage it if you have a long-term care event about 4 times its value. So they'll pay for about 400,000. Again, I'm not giving you exact numbers. It's dependent on your age and other factors, but based on what I've seen, it's about a 1 to 4 ratio.
Yeah. I think I
So,
came to the same conclusion
yeah.
independently that the very specific long-term health insurance is a very small event, and if you don't use it, you lose it. And some would say that's how insurance works. If your
Yes,
house doesn't burn down, you don't use it. But I
correct.
think we play this game of the infinite banking or the life insurance where we want our cake and eat it too. The problem, I think, where it comes in, and correct me if I'm wrong here, is if you're not young enough or you don't qualify for that life insurance, then you're stuck getting it with everybody else then. So
Exact. And absolutely, if we didn't have other options and traditional long-term care insurance was our only option, of course we want protection. That's why we get car insurance. That's what we get home insurance, right? But there are other options. So that's why I put them to consideration.
yeah, I think that most of the folks here were doing the infinite banking. Everybody should have went through that e-course already that we have. If anything, it's for getting family members, especially the older folks. They can't really qualify for the life insurance, infinite banking stuff, so they're stuck
Yeah, that's
going
where
through that.
annuities could come in. An annuity with a long-term care rider, if they don't qualify for life insurance or the hybrid long-term care policies I mentioned. But of course, it's very personal. It's a case-by-case basis.
Yeah.
And in fact, that's why we do this analysis because it is unique. Not everybody has these numbers. Just like not everybody has the same numbers when they go to the doctor. If you look at this, we just looked at a $16 million family on the asset side where 13.1 million were investments, but they are constrained. And these are what I call their financial markers, similar to our biomarkers. Just think about it when you get your blood work done or your urine tests, and they tell you your cholesterol is high or your blood sugar is high or your PSA may be high or some other hormone for women, or estrogen is low, who knows? But this is the same idea, except that this is financial, right? So that's why I like to call this a financial health analysis, because that's really what it is. And so I want to know now rather than later, what is my financial health today so I can take some action and start looking at those investment opportunities. If it's real estate, if it's stocks, if it's bonds, if it's private equity, whatever is the right thing for me. And there is not a one size fits all, but this starts to tell us how strong your balance sheet is in order for you to meet your goals. Because think maybe if I asked any of you right now, let's just use $1 million because it's easy. If I asked any of you, is that enough money? Is it not enough money? I think $1 million in today's world is not that much money, but it's nothing to sneeze at. Nobody's going to turn down $1 million, I would say, right? Now, I have people who ask me, what would you do if I gave you $1 million? How would you invest it? And unfortunately, I have to answer with a question. What are you trying to accomplish? Oh, I just want to make as much money as possible. Maybe you should go to Las Vegas because you could double your money in one day. If you want to make as much money as possible, then have you thought about risk? Your chances are very low that you're going to double your money in one day, but that is making as much money as possible, right? So we have to think about it in the context of what you're trying to accomplish and how much risk you can afford to take If I know of the $16.1 million that is expected to be their lifetime spending, if I know 2.9 million is going to be covered by their earnings and their social security income, then the rest has to be covered from their investments, right? So I'm subtracting the 2.9 from all expenses and liabilities. And now I know that they need 13.2 million to cover the rest of their lifetime expenses. That becomes their income floor, meaning they never really want their investments to go below 13.2 million in order to be able to meet their lifetime of expenses. I'm going to take these 13.2 million and I'm going to break them up into reserves, which the reserves doesn't mean it's not invested. It just means it's more conservative than the floor. But the floor is more conservative than if they had upside potential. So back to this slide, this is where they can take bigger risk, the 44, almost 45,000, right? This is where you would think, oh, private equity, put it in a startup, put it in a VC fund, maybe in real estate, depending the level of risk. Real estate could be in here or it could be in the more conservative, depending on the situation. Right now, I know that they have an unfunded floor of $621,000 because I've gone through this analysis. So it's not a dire situation for this family because if they sell their home and downsize, obviously that means they sell and then buy something at a lower cost. And if he sells his business, which he thinks he can sell for about $15 million, so that's a big if, right? Is there going to be the right buyer at the right time? And that's the beauty of this system is that we can do so many scenarios. What if you sell at 15? What if you sell at 5, etc. But this is the scenario they wanted us to consider. Now look at the difference. Obviously, their spending seems to have gone up, but that's because if you sell a business for 15 million, you're going to pay a lot of money in taxes. The next conversation is what could we do to help them save some money from taxes, right? So this is just a pure post sale. Where this would bring them is to an overfunded scenario. Now they're depending on which coverage ratio I use, overfunded or well funded. And then just briefly to address what if instead of just doing some planning of, okay, you sell your business, let's talk after you sell. What if we do some pre-planning? That meant maybe gifting some shares of the business into charitable lead annuity trusts or some other type of trusts. Ultimately, in this scenario, they're saving $2 million in taxes. So their cushion went from 13 million in the previous scenario to 15 million. In other words, from 21 million in expenses and liabilities to 19 million. They didn't eliminate taxes completely, but they saved $2 million thanks to some pre-planning. I can briefly just go over this scenario. This family, very different situation, as you can tell. Also, quite a few years of human capital, so money that's going to continue to come in. Their social capital looks better because now we have two incomes of Social Security throughout their lives.
I just wanted to point that out. So the first one is like assets, right? Like we always say, buy assets. So it produces income for you and it grows. The
Yes,
human capital is you trading time for money.
correct.
And then social capital, I guess not a lot of us have that thing these days. I'm going to replace that with. That's the only
Social
reason.
Security is still around in the future. That's where it would come from. It would be some pension money if you have a pension. Not many people have a pension anymore, but it's a social contract that somebody's going to pay you money in the future for work you've done in the past, right? Whereas the financial capital here, it's you have your 401ks, your 403bs, your IRAs, your taxable investment accounts. Your real estate isn't in here. the value of your real estate isn't in here. If you own real estate, the cash flows, the income that comes from that real estate is down here, as is the case with this family. So this is the value, the present value of the future cash flows from a property they rent part of the year, right? They use it for their vacations and then the rest of the year they rent it out. But because we saw that they had a negative cushion, we have to go to the drawing board and say, okay, are you willing to work longer? Would it make sense to sell the vacation home, to downsize? In this analysis, the one thing we're not doing is projecting returns. Why? Because we can't promise returns. There is another analysis that we use called the Monte Carlo simulation that stress tests a portfolio through 1,000 different scenarios of ups and downs of what could happen in the market. When I'm trying to assess somebody's financial health, I don't want to predict what's going to happen. Just like when you go to the doctor's not going to care if you say, I promise I'm not going to eat red meat anymore, or I am going to exercise every day. The doctor's going to say, come back next year or in 6 months and let's see the results of what happened. So that's why we do this on a frequent basis, because we want to see, oh, your portfolio is up. Now maybe you don't have to work that extra year, or you got an inheritance. You don't have to worry about selling the real estate. You can keep it and just enjoy those cash flows, whatever it may be. Tax laws change, economies change, interest rates change. That is all affecting these balance sheets. So obviously in this case, they also had an unfunded floor. And again, the floor is the money you want to protect and not take unnecessary risk. When you have a positive cushion and when your coverage ratios are not constrained, then is when you can think about doing things. So here it's the same family. We did 2 different scenarios. This is one of them where they work a few more years. Their social capital hasn't changed. The financial capital hasn't changed, but they actually sell the vacation home and they downsize. So 2 real estate properties have been sold in this case. They buy another one because you need to live somewhere. But this is the extra money that didn't go towards buying the other property. The purchase amount is in this 7.6 million. And now they have a $957,000 cushion. So their new income floor is 1.5 million. Now they have 621,000. That this is just to start thinking about how to allocate your money. This 621,000 could be for an unexpected emergency in the future, but it also could be for opportunities. I want to start a new business, or I want to go into this private equity fund, or I want to invest with Lane in one of the real estate deals. It just helps us start about thinking how you're going to allocate your investments.
This is the
Eh,
like Susie Orman thing where like the segment where she's, can I afford it? And she's, no, you can't, you're broke. Sometimes we don't have too many non-accredited investors like book onboarding calls with myself, but I still enjoy these calls because it's a lot of people, they just don't have people around them and give them a second opinion, but it'll be somebody who makes barely 60 grand per year. They're a younger person and they're trying to buy this big house, and I'm like, dude, what are you thinking? I have to get the calculator out. Like, you can't do that. But I guess, so you're talking to people on the other side of the mountain on this, right? People with, I mean, you work with all kinds of ranges, but like, just say 4 to 5 million net worth, which is like this person here. I'm assuming this is the coming to Jesus moment for a lot of people, and then walk them through this uncomfortable situation where, oh, shoot, we don't have enough. We better keep investing or keep working this day job. And part of it is you have to decrease expenses a little bit. But what normally happens in these cases? How do people normally react? They cut expenses, they keep working, or invest more aggressively. What do people normally do in that network?
Yeah, I see a range of reactions, but I have to say, in most cases, people aren't surprised when I show them a negative cushion. I met with a couple not too long ago whose combined income is $800,000 a year. So many people would love to have that level of income. And it's a newer stage in their lives. They weren't always making that much money. But what often happens is that as we start to make more money, we start to spend more money. So all of a sudden, oh, I couldn't go out to eat every weekend. Now I go out to eat twice a weekend. Or I rarely would buy the latest gadget or upgrade my phone every year or get a new car every year. Now I do that. So in this case, this family, they had a gap that was over $4 million. Their cushion was a negative 4 million. It felt like it was almost a relief because now they knew it was true. They had that idea in their head and now they knew what they had to do something about it. So are your tax strategies in place? So just looking at the tax return, are you paying too much in capital gains tax? Why isn't there more active tax loss harvesting? Are you taking all the deductions you can take? For example, a spousal IRA. It's not huge, but it is a deduction, right? It's going to reduce your adjusted gross income. The next place I go is in the non-essential, right? So maybe somebody said, we need $15,000 a year for travel. Okay, can we start to talk about $7,000 a year for travel? Maybe only do one big trip a year? Because just like in investing, spending and inflation compounds, right? So $7,000 saving 1 year might not seem like a lot, but if we add the inflation that's compounding and we save those 7,000 over 10 years, it makes a big difference. Obviously, we're looking at how their investments are allocated, if they're taking unnecessary risks, if they're missing out on opportunities. What I'm seeing a lot is because large cap growth has had such a run, people are not as diversified into international and emerging markets. But over time, if your money needs to last you 30 to 50 years, right? If you're 65 today and your money is going to last you to 95, if you're 55 and it's going to last you to 95, if you're 45, whatever the age is, we forget, we think about, it's hard to think about our future selves. It's easier to think about, okay, I'm just doing this right now. In the future, I'll change. It's the same thing with the gym. I'm not going to go to the gym today, but I know I will in the future. Are you? Or is that the same story in the future? In any case, if your money needs to last 30, 40, or 50 years, and you know that emerging markets historically has contributed the growth of a portfolio significantly, then why wouldn't you be diversifying? Or do we think that US large cap growth is place to stop? So why aren't I just in the S&P 500? So those are the kinds of things that I'm seeing, Lane, where people have some opportunities to make changes. I love seeing progress. Another family started working me when they were with me when they were in their mid 30s. They had some money in their 401ks. Not everybody that comes to us already has $2 million. But they've been very consistent with the meetings and the planning, and their careers have taken off as well. It's not all about the planning. Obviously, if they're doing planning, then they're thinking, let me connect my human capital to this. Can I make more money in my career? And now they're not only funding their 401ks and they have an investment account outside of their 401ks, they've bought 2 condos to rent in the city. So I love seeing that. It's like accompanying somebody their journey, just like maybe a doctor accompanies somebody through somebody's health journey and sees them improve in that area.
Yeah, it is very much health, right? In health, you get a heart attack or you get some kind of scare in a screening, and then that kind of shakes you back. But here, you could do something like this at any point, and you project out based on your current path. But most people, you go through this exercise, they're underfunded. I take it, right?
At the beginning, most people, there are definitely clients that I'm like, wow, you're in great shape, you're overfunded. But if there are still some opportunities, sometimes the opportunity that they wake up to, if you will, when they go through this exercise and they are overfunded is that we could really be doing more. So maybe we could be giving more to our donor advised fund, or we could be already gifting to our children, or we could be investing in something that we thought we couldn't afford to take the risk. So it just opens up like this new conversation in terms of, for lack of a better term, opportunities.
Yeah, they're wasting their time when they don't really need to trade time for money.
Correct. I've seen families who they're like, oh, we're going to travel more. And maybe they were raised by the silent generation. Their parents may have been part of the Great Depression and their parents were very frugal. And most of my clients didn't start with a lot of money, right? So they're still thinking like when they didn't have a lot of money, they still see themselves as those people that need to be careful. And obviously, we all need to be careful because you can have a lot of money, and we've all heard about the professional athlete or celebrity that's gone bankrupt because there wasn't the education or the guidance that they needed. But sometimes getting them to think about their wealth in terms of you are in a different point in your life. You can now do certain things you couldn't do before. It gives them a lot of confidence to do those things.
You almost have to put your head down to just grind at it and not really pay attention to the score to really stay motivated. Not everybody could be a professional athlete or sell their business
Correct.
for 5 million
Correct.
plus.
I agree, Lane. I think that's most people. We are putting in the hour, trading time for money, and hopefully we're converting our human capital to financial capital, which just gives us freedom of choice. And I think that's what it all comes down to. That's what we want, to have that freedom of choice. And it's definitely all about behaviors. So behavioral science shows us that there's the person we think we can be and the person we are today, what the gap is. And that gap is where either we're going to get stuck because we're not making the changes we need to make, or we're going to start filling in that gap either with a shovel or with a tablespoon, depending on how committed we are to doing the things we need to do. But I want to emphasize that this exercise is powerful in providing you knowledge. There's nothing like knowing where you stand. How many times have you heard about somebody that went to the doctors and was like, thank goodness I went because they found this and it's early and they got rid of it. And if I had waited, it could have been much more problematic.
Well, what is the safe withdrawal rate in retirement, in your opinion?
In my opinion, it would be 3.5% or less. That at least for the first 7 years of retirement. And that's based on these coverage ratios that I was sharing with you. It used to be the 4% rule. I'm sure you've heard of it. Then there's been talk of the 3% rule. I don't call this the 3.5% rule. It's 3.5% or less. So again, depending on what your situation is, and then I'll just remind you of two things. So with withdrawal rates are affected by the sequence of returns and the sequence of withdrawals, meaning sequence of returns means obviously 1 year, the market's up, let's say 20%, you withdraw 3.5%, you're golden. But if the next year it's down 20% and you withdraw 3.5%, now you're down 23.5%. So you have even more to make up for, right? So you have to take that into consideration. Sequence of withdrawals means not every year is going to be 3.5%. That's why if it's even lower, it's better. Because 1 year, unfortunately, you may need some kind of additional health care, or you didn't know that your basement was going to flood and insurance only covered $5,000 and the cost is around 30, right? So
Has some health problems and you want to take all 20 of your family members on a VIP tour of Disneyland. Could be other expenses like that too.
Yeah, so hopefully that answers your question.
I like this whole this what do we call this, Marcel? Net present value method or something like that. But that question is, who are you? How old you are? What's your burn rate? And that's what this little mental exercise was supposed to be doing today. And the way I saw it, like my takeaway of it, is a lot of it is based on how old you are, how much years of runway you have to account going to 95. I think that's what drives this model a lot.
And yes, absolutely how old you are. Or would you also agree that how much you spend drives this model too? Because I've had clients who've retired at a traditional age with about $800,000 saved. In this case, he had a pension, so that made a huge difference. But their withdrawal rate is below 1% because they got used to living a certain lifestyle. Take that same family, even at the 3.5%, but if they go above a 3.5% withdrawal rate, it's going to be same age, same amount of money, but the amount they're spending will change the outcome dramatically. So it's definitely a combination of things. It's not just one thing.
I'll close today's call out with reverberation of what you were just mentioning earlier. I think most of us go to a point where we have too much money and then we're overfunded in any way. We've had maybe, I think we're getting close to 1,000 live investors that people have actually invested with us in the past. There's over 10,000 people on the email list. I don't know what y'all are doing out there. I don't know if we've had a chance to talk. You guys should step out of the shadows and get a little bit more intentional about this. If you feel like you're overfunded, go out and spend the damn money, is what I say. I've talked to a lot of people in their 20s that save $150,000, $200,000 a year. And I'm like, you guys are well ahead of the curve, even with very financially adept people, and like maybe live a little. But I say that because with 1,000 people that we've worked with in the past, I've certainly seen people counted on one hand that talk to them and then their spouse dies the next time I have a call with them. Just life just changes right away. So that's certainly out there. That's the heart attack or something like that happens after the fact.